Okay, so first of all, welcome everyone. My name is Derek Frey. I'm the Senior Market Strategist at Forex Traders Daily, and going to be going over basically my favorite patterns to trade. I am a technical trader. I don't trade fundamentals. I trade well with a lot of different things, but primarily what I'm going to show you guys today is the patterns that I use and that I prefer. Of course, there's almost an infinite number of trading patterns out there. If you read Marty Pring's book or John Murphy's book, which are the two basic textbooks for technical analysis as it is, they have just a whole wealth of patterns out there. I've used every single one of them, to be completely honest. The patterns, like I said, I've used every different pattern that's been out there, and in my experience, I've been trading now for about 20 years. And in my experience, I've honed it down to about a half a dozen different patterns that I really focus in on. They're pretty basic. I don't know if they're basic. Some of them are pretty advanced, but a lot of them are going to be familiar to you. I'm going to show you, and I'm not here to teach the classic way of doing these pattern trading. I'm teaching my way of doing it, which is whatever. I'm not saying my way is better than the classical way or worse. It's just my way. One of the fundamental things that all traders have to wrestle with and deal with is the fact that you have to find a method for trading that fits your style, that fits your personality. I can't overstress the importance of this. People think that trading is a mechanical, mathematical endeavor. It is not. That is a small piece of the puzzle. It is an enormous psychological endeavor. So it's very important to deal with that side of things. So anyway, the patterns that, well, let me get started. I've got a presentation here. Long-term profitable on a real account. Well, how about I qualify it by saying it this way? I've been doing it for almost 20 years now. It's pretty unlikely, if I wasn't doing at least okay, that I'd still be here, right? Yeah, I mean, you can find me on Collective 2. You can find me. I have all kinds of places. Collective 2 is a third-party verification system for trading. I've only been on there for a few weeks. I just got started there. Somebody just turned me onto it, but you can check it out there. I have my trading room, so that has results that you can see and whatnot. So anyway, no, I know. I'm just saying that. Anyway. All right, so let's get started. Give me just a second here, and I'm going to fire up the PowerPoint presentation that I have. Okay, guys. Before I get started, do you see, is the PowerPoint coming through? Everything okay? And is my audio okay? Still, hopefully? Okay, then I'm going to get started. So, kind of already let the cat out of the bag here. One of my primary patterns that I like to use is the Gartley pattern. There are a number of, there's one classical Gartley pattern, of course, the original Gartley pattern, and we'll go over that. And then there's others, I call them sub-patterns. I think Scott and Bryce and Larry would beat me up if they heard me calling them sub-patterns. They're really their own patterns, but they're kind of cousins of the Gartley. The underlying construction of the Gartley is just as relevant for these other sub-patterns, as I call them. So anyway, we'll cross that bridge when we get to it. But so an intro to Gartley patterns. What is the Gartley pattern? This is what we're going to cover here today. What is the Gartley pattern? What's the history of it and why it works? How could it help in your trading? That's obviously why you're all here, really. How to recognize the Gartley pattern, and we're going to talk about these bonus patterns, the crab, the butterfly, the bat, and then the Gartley 5-0. So what's behind the Gartley pattern? I'll give you a little bit of history here. The Gartley pattern was written by H.M. Gartley in 1935. The book was called Profits in the Stock Market, and in 1935, the book costs $1,500. Now, if you go back to 1935, that was an enormous amount of money. You could literally buy 3 cars back then for $1,500. The average car cost about $500 back then. So this book was not cheap. He was, he was very much trying to not let the masses have access to this, if you will, by setting the price so high. I mean, think about it. The average car today is what, 20 grand? 15 grand? I don't know. Say it's 15 grand, let's say. I mean, that means that this book would be $45,000 today. Now, it's not. You can actually go buy this book, a reprint of it, from a number of places online for about $100. But it's and it's an interesting read, and I anybody who's interested, go for it. But the pattern itself that Gartley initially uncovered back in 1935 has been modified since then and has been made more robust. And we'll cover that here today. So Gartley is a technically geared stuff that is basically a bunch of fib measurements to form a specific price pattern. The original pattern was first read on page 222. Sometimes it's referred to as the Gartley 222 pattern, and people always ask, why is it called Gartley 222? Does that have something to do with the math? And actually, no, it has nothing to do with the math. It has to do with page in the book. That's why they called it the 222 pattern. It's kind of funny. Originally, Gartley did not even include Fibonacci measurements in his first book, and his first application of the Gartley pattern did not involve Fibonacci ratios. It involved 1/3 and 2/3 ratios, but not fib ratios. Of course, 1/3 and 2/3 are not fibs. This pattern is an evolution, and it is still in process, and it frankly will continue to evolve over time. How does this pattern help us? It's a classic retracement pattern. It offers a logical place to put a stop. Most of you are, one of the questions I get all the time on FX Street is, how do I know where to place my stop? Using this pattern answers that question for you in a very mechanical way. So you don't have to guess anymore. Frankly, it tells you where to put your stop. So it's a very nice, from the risk management point of view, that it gives you very clear, defined place to place a stop. And it's a logical place. It's not just a random, hey, we're going to run a 50-point stop. Ridiculous like that. It's actually a logical, specific place on the charts that has a technical significance for being there, rather than just, I only want to risk 50 points or something like that. For day traders, I don't know why, short-term, sorry. For short-term day traders, the pattern can be used effectively to buy and sell tests of highs and lows on an intraday basis. And then, of course, here's the best part. This pattern has over a 70% accuracy rating going back at least 75 years. And this has been independently tested by a number of people. So it's not my numbers that I'm relying on alone. I've seen there's a lot of corroborating evidence that shows that this pattern is better than 70% accurate. So that's unusual. There's not very many things in the trading world that are accurate to 70%. How many traders do you know that have a win ratio that's better than 70%? I know about 10,000 traders, and I can think of about 3. So it's a pretty significant thing, to say the least. So before we get into this, we have to explore a little bit about Fibonacci. I know everybody that's traded has heard of Fibonacci. Many of you probably use it. Many of you, some of you at least, may have done some homework and know why Fibonacci is what it is. Some of you don't. I'm going to go through and show you some neat stuff real quick here. I'm going to break away from this PowerPoint presentation and actually pull up an Excel spreadsheet. And this is an exercise that you can all do. I've done this exercise before with some people, but I really want to do it with you guys here because it really, for me, personally speaking, it's magical. We're going to go do a little bit of mathematical magic in a way, because what ultimately happens here is borderline crazy. And that's why, part of why Fibonacci works so well is because what we're going to do here happens. So the first part I'm going to do here, I'm going to break away from this presentation and go fire up Excel, like I said. If any of you have Excel, do this with me. It's super easy. This is not going to be hard. If you don't have Excel, you can get OpenOffice or whatever. Any spreadsheet function will do. It doesn't matter what it is. Just give me a quick second to get it fired up here. Okay. I'm going to reset the cam just to make sure everybody can see it. So here we are, just a basic spreadsheet. Okay. Now, everyone knows the first number in the Fibonacci sequence is 0, right? So we'll put 0 in the first cell. Everybody knows 1 is the next cell, right? The next number in the sequence, okay? So then you all, well, I don't know if you know the terminology of this or not, but what the Fibonacci sequence is called a recursive series in mathematics. A recursive series is, or set is basically an infinite series that when you basically you're adding two numbers and then you're taking the product and one of the two numbers that were added, usually the last one, and adding those together to get a new product, and so on ad infinitum. So all we got to do here for Excel, again, this is super duper easy math. If you know how to use Excel to put in a function, you just hit the equal sign, and then we just click here, hit the plus sign, click here, and hit enter, because that's, 0 plus 1 equals 1. Now, if you want to extend the formula to get the fib sequence, all you have to do is get your little cursor to show this little, you see how, I don't mean to give you guys a lesson in Excel, but at the same time, you get the small plus sign on the bottom right-hand corner of the cell here, and you just drag the formula, and you'll see that the fib sequence will show itself. 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on. That's the fib sequence. You're all aware of that, right? So that's not the magic yet. The magic is coming. So now let's find out why this 0.618 fib ratio is so important. What we found, or what Fibonacci found, well, actually he didn't uncover this stuff. The Hindus did a long time before he came around. But anyway, what they found was that when you take any number in this series and divide it by the previous number, once you pass the what's called the eighth harmonic, you get the golden mean, 0.618. So let's do that again here real quick. It's real simple. You get 1618, and then there's the other way to do it, of course. We'll give you this divided by this. Give you 0.618. And then, again, if you stretch the formula, remember, I'm not copying and pasting. It looks like I'm copying and pasting because the numbers come out almost the same. But I'm not copying and pasting here. I'm copying the formula, not the numbers. And then after the formula runs, the numbers are coming out the same. You guys see how this is almost magical? Now here's the really neat part, okay? This is using the fib sequence, so everybody thinks, okay, well, of course that's going to work out because it's the fib sequence. But I'm going to show you that it has nothing to do with the fib sequence, believe it or not. So somebody call out two numbers, any two numbers, I don't care, or two people. Somebody call out one number and somebody call out another number so that we know it's different. All right, the first number I got here is 17, and the second one was 27. So look, we'll put 17 in the first cell, and we'll put 27 in the next one. It doesn't matter. You could have done 3 digits, 4 digits, 10 digits, a million digits. It makes no difference. But you have the same function here. You have the same recursive series. So, 27 plus 17 is 44. 44 plus 27 is 71. 71 plus 44 is 115, and so on down the line. But notice, the ratios between them does not shift. No matter what numbers you put in, the ratios do not shift. Does anybody else understand the power of this here? Or the almost impossibility that this is random? I mean, this is a beautiful, beautiful example of chaos theory in action. Because you guys are giving me random numbers here. Joseph put in 47775. We'll use that. It's a nice big number. Because it makes no difference. I really want to be clear on this point because I know that this may seem either overly simplistic or not that important, but realize what's happening here. There's mathematical magic going on here. So the reason I say this is chaos, this is an example of chaos theory, is because if you study chaos theory the way I do, I'm a chaologist, you know that chaos theory is not the study of chaos. It's the study of order. It's the study of structure. It's a misnomer the way it was named. It's actually, when we study chaos, we're not studying randomness. We're studying the lack of randomness, actually. So here you have two quote-unquote random numbers, right? two quote-unquote random numbers that have no relationship to each other. You guys pulled them out of the air. I'm just randomly typing numbers in here right now and just hitting it. As you can see, it makes no difference. And yet the ratios are still the same. So from seemingly two random numbers with a recursive series, by just the eighth harmonic, we don't have to go out very far for this to start showing up. By just the eighth harmonic, you have the fib ratios showing up. And they're a constant. Notice that down here they become constant, no matter how far you take this series. I mean, if you go down infinitely here, I'll go down 1,000 cells. These numbers are probably going to crash the computer almost, but because they're so big. But no matter what, the bottom line is that the ratios remain the same. That's the magic of Fibonacci. That's why it's so important, because you cannot say that this is random. You have seeming disorder or seeming lack of structure, randomness in the two starting points, and yet no matter what you do, no matter what inputs you put in there, you're getting order. You're getting very, very clear order. Not only, it's not just slightly ordered, it's extremely structured and ordered, like to a point that's almost beyond comprehension on a human level. So am I clear? This is why Fibonacci is important, because it's everywhere and because it describes nature. You guys with me? Everybody understand this? Okay, wait. Could you please go over 2 and 3 again, as I missed it? 2 and 3. You mean how about 4, 8, 15, 16, 23, 42? What do you mean? I mean, I'll plug all those numbers in, sure. 4, 8. I mean, it doesn't matter what numbers you plug in, you know. It makes absolutely no difference. The ratios are always the same. Any two numbers makes no difference. You can see me putting them in here right now, right? Doesn't matter. Make them as big or as little as you want. You can even use fractions or decimals. 0.7, here, go 0.00000008964, doesn't matter, whatever. Even if you use fractions, decimals, it makes no difference what numbers you choose. The bottom line is the ratio continues to show up. Now, I'm not pretending to explain why this shows up. I don't think there's a single person in this universe that can answer that question. But I don't need to know why to be able to use it. I don't know exactly why my car works when I turn the key, but I can still drive it. How did you get column C? Column C is simply dividing the A11 versus A12 in this case, basically dividing the first number in the series by the next number. This one is the opposite, dividing the second number in the series by the first number. That's all. Yeah, I can show it from 0 again, sure. Oops, 0, 1. So that's the real fib sequence itself. So is this clear? I know I'm spending a lot of time on this, and I don't mean to necessarily beat a dead horse here, but the whole basis of the Gartley pattern is the Fibonacci sequence and the Fibonacci ratios. So I want you to be completely understanding why we're using the Fibonacci sequence, and it's not just because it's popular in trading circles. That's ridiculous, frankly. It's because it makes sense in nature, and because we can't explain how this happens so much, and yet it's here. We can't deny it. All right, so I think that horse is dead. Everybody satisfied with that? All right, so let's go back over to the presentation. Okay, another thing here. let me refresh the screen too. I don't know. The eighth harmonic test, I'm not really going to go over that. That's like I was saying, that's in what we were just looking at. Once you get to the eighth number in the sequence, the ratio becomes evident. The ratio is really not there before the eighth, and somebody's going to ask why, but it's a very long-winded mathematical explanation that is not really relevant for trading purposes. If you're interested in doing the research, go for it, and I certainly can guide you to some places, but it's not important for our purposes here today. All right, so both price and time are important. If you guys have been with me on other webinars on FX Street, I've talked about this probably ad nauseum for some of you. Time is extremely important. The 90% of losers out there are not looking at time for the most part. Okay, some of them are, but for the most part, they're not looking at time. They're only looking at price. They're only looking at the vertical side of the scale. Remember, a chart is both a vertical and a horizontal, and you can't have one without the other. So time is at least a 50% component, and I would argue much more than that. And let me give you this example, this when versus what example. What do you think as a trader it's more important to know? Or if I could tell you, you all know that nobody can predict the future. So, but let's just pretend for a second that we can, or that I can, okay? If I could tell you one thing, just one thing, with 100% certainty about the future, no question that it's going to happen, okay? What would you rather know? What is going to happen, but not when, or when something's going to happen, but not what? As a trader, which one is more valuable? Right, good. I'm glad we're on the same page there. That makes me happy. When is the most important piece of the puzzle, not what. Because even if you know what's going to happen, it doesn't tell you anything about when. You follow me? You could know that gold's going to go to, say, $1,500 an ounce or whatever. It doesn't matter. But what good does that information do you, even if you know it's going to happen with 100% certainty, if you don't know when? How is that information going to be valuable? It's not. In fact, it's probably going to be detrimental to your trading. Am I right? So the when part of the equation is extremely important, much more important than what, or why, or how. And it's the part of the equation that the 90% are all but ignoring. And, of course, the point here is it's also one of the questions, or one of the things that Gartley does for us. It does tell us basically when. So let's get started. Let's keep going. Okay, so this is the basic Gartley pattern. Again, it was discovered by him in 1935. The critical aspect of the Gartley pattern is the B point retracement, which must be at a 0.618 of the XA leg. Now, again, this is going to start getting technical. The B point, as you can see here, is the heart of these patterns. It's the most important piece of the puzzle because it's basically what all the other projections in terms of targets and in terms of other things are built off of. The AB wave is what you use to measure your, like I said, your targets and all the other pieces of the puzzle. So the B point is absolutely critical, and the B point in the traditional Gartley pattern needs to be at least 0.618 of X. Does that make sense? So if this was 100 points, if from X to A was 100 points, from A to B needs to be 61 points, roughly. Does that make sense? Now, again, like I said, I don't believe in the concept of perfection. So this says it must be at 0.618. Other people like Pesavento would argue, Scott Carney, I think, is the one who says it must be at 0.618. Pesavento allows for it to go up to the 0.786. So anything from 0.618 to 0.786 would work, or would still be considered valid in most circles. So anyway, the point is just that you have the B point here, and it's a 0.618 of the XA leg. Are we clear on that? In measurements or pips? In measurements, in Fib measurements, ultimately. I did it in pips to try to make it simple, saying that this is 100 points and this is a 61-point retracement. But ultimately, you're measuring it in fibs. This dotted line here, it's not saying that the distance between here and here. See, people get confused when they look at this, and let me try to clear the confusion up right now. This is not saying that the distance between B and X is 0.618. It's just drawing the line so that you know that it's saying that the B is a 0.618 of X. Okay? Does that make sense? Don't get confused. They're not trying to measure the distance between here and here. Well, this is a bullish Gartley and this is a bearish Gartley. Okay? The setups are the same. It's just, you know, the mirror image. This is just flipped over. Sorry, this is just a flipped over version of this, basically. And more or less the same thing. Not more or less, they are the same thing, just 180 degrees around. Yeah, no, you don't need to get a tape measure out for your charts. Okay, so here's the Gartley setup. There's 3 steps that we have to go through. There is a distinct AB equals CD pattern involved here, and that's what we're going to go through. AB equals CD basically means that it's how do I say this? It's saying that your AB leg needs to be roughly equal in both price and time. The measurements are done via the fibs. You'll see here in a minute, Boyke. I'll show you. I'm getting there. Okay, so here's setup number 1. The first thing you have to find is an X point. An X point is nothing more than basically a prior high or a prior low. You can kind of pull them out of anywhere. It's not as critical as you might think what your X point is, because you ultimately want to run them on everything, on every high and low. Start X out and see if a Gartley shows itself. So we have the X point here. This happens to be the British pound, but it's irrelevant. And by the way, first of all, this pattern works in all markets. This is, you know, it's 6 to 1/2 doesn't. The fact that we're showing this in a Forex environment is not relevant. It doesn't matter. You could all be stock traders. You could all be bond traders. You could all be currency. Well, you are currency traders. You could all be commodity traders. It makes absolutely no difference. This pattern is 100% valid across all markets. Period. All patterns should be valid, frankly, across all markets. If they're not, then there's something else fundamentally wrong. Theoretically, it's usable in all time frames. However, I do not use these below 15 minutes. You can, people do, and I'm not saying there's anything wrong with it, but I'm just telling you again, I'm not trying to tell you the textbook way of doing this stuff. If you want to learn that, pick up the textbook. I'm teaching you my way. All right, so once you have your X point, you're simply looking for the next major low in the cycle to find your A point. And in this case, this is a bearish pattern that we're looking at right now. But the key here is you see how you have roughly AB equals CD, both in price and time. And how do we measure time? We count the bars. It went up. This leg here is roughly what? I don't know. Call it 500 points, as is this one, roughly. And at the same time, notice that you have 1, 2, 3, 4, 5 bars here, and you have 1, 2, 3, 4, 5, 6 bars here. It's not necessarily going to be exact, but they're usually going to be close. It's even better if the distance, the number of the time factor between the A, B, and CD waves conforms to the Fib sequence as well. In other words, if like for instance, if this was 11 bars, okay, and this was 17 bars, 17 bars is 1618 of 11 bars. That would be even better because it's showing even more structure on the time side of the equation, not just the price side of the equation. Does that make sense? So then here's the completed pattern, and your entry signals are given when the D point is formed. So you had signals to go short at the D point, and like I said, your stop is going to be above your X point. And I'll show that in a little more detail. Once you have the signal, now this is where the D point was, okay? Your targets are also Fib ratios of the underlying move from A to D, okay? So the underlying A to D wave here, the first target is this. I tried to make it so you could see this with orange. It's not showing up the best, I don't think, but you get the idea here. This is your first target here at the 38% Fib retracement level. Your second target is the 62% Fib retracement level. And your third and final target is the 1618 extension. That's your longer term target. Okay, does that make sense? I'm going to keep going here. Just keep going, keep asking questions. Precise 618 percent B point retracement. Sorry, that should be 0.618 of the XA leg. BC projection must not exceed 1.618. So in other words, if the D point is greater than 1618 of the AB move, then it invalidates the pattern. Okay. The equivalent AB equals CD pattern is most common. Like I said, it's the best case scenario is to have some sort of a AB equals CD pattern inherent in the structure, preferably using time. And a 0.786 XA retracement gives us the D. And a C point has a range of 0.382 to 0.886. See, the C point can go deeper. This is what they're trying to say here. There's a range. It's not a precise exact place. It's a range. Okay? And this is for the bearish pattern. All the measurements are the same for the bearish and the bullish. So they're just flipped around. Okay? You want similarities in slope and thrust on any of the moves? All right, so that's the basic Gartley. The next thing we're going to go over is the butterfly, which is a little bit more advanced. And yeah, guys, by the way, I am going to do live trading in the second half of this webinar, which I think we start at 11, I believe. So we are going to go through and do live trading and look for all of these patterns. That's why the first half of this is to go through and get you understanding what it is, and then we'll go through in the second half with all the premium members at least, and do some live trading and live. I can't promise we'll trade, but if we find patterns that are tradable, then we will. If we don't, then we won't. You don't force trades ever, unless you like losing. Right, yeah, good. So we do start at 11 for the premium users, and so we will go through all the charts. That I'm not going to go through anything real time right now because I'm saving it for them. I can get you the Gartley stuff for MetaTrader. At the end of this, we'll have something for you. What else? Okay, so before I go on to the bat and the butterfly and the crab and all the other cousins of Gartley, we'll call them, are we comfortable with the basic Gartley pattern? And don't say, don't let me off the hook. This is your time. I want to make sure we're clear. So if you want me to explain it a different way or another way or again or whatever, I'm not opposed. It's more important that it's clear than anything. All right, it looks like we're pretty clear. Okay. Bullet 4. 0.786. You mean this one here? Bullet 4? Okay. 0.786 XA retracement. What they're saying here is the D point, okay? This D point right here is a 0.786 retracement of the XA leg. Okay, so if this moves, I'll do this in 100 points again to make it easy so that you kind of can see it a little easier. If the distance from X to A is 100 points, then the distance from A to D would be 78 points. Does that make sense? That's basically what a 0.78% retracement is telling you. If you were using of course you're never really going to get an exact 100-point move like that, so it's not going to work out that simple. That's why we use the measurements, the fibs themselves, not trying to count pips or anything like that, because it doesn't really work that way. Yes, in this case, from the D point, it's down. Michael. The continuation after the D, how far will it go? All right, well, let's go back to the target. Okay. Whoops. Page up, page up. There we go. Here's the target. First target's a 38% retracement of the XD legs, XD waves, excuse me, which is right here. The second target is the 62% retracement, or 61.8% retracement of the AD leg. Okay, right here. And then the long-term target, the macro target, is the 1618 extension, fib extension. Do you all know what the 1618 fib extension is representing? We'll go over that as well if you need me to. It's just extending this 1618 is a 0.61 extension of the A point. That's ultimately what it really is. Just like this is a 62% retracement from the A point right here, this is in the opposite direction. That's all. Right, it's the next harmonic. Thank you, Joe. The X on this graph is right here. This is your X point right here. Here, let me go back. That's the X point. That's the same chart that we were just looking at. It just has it drawn out without the projections. So that's what it would look like. Let's see. I'm trying to keep up with all your questions. Keep asking questions, guys. It's good stuff. That's why I'm here. I know this stuff, so the questions are what I'm here for, to help. What if it's 75 points? That's out of context now. Ask me that again. How to differentiate reversal 1, 2, 3 pattern and the Gartley pattern? Sure, the Gartley pattern is a very precise, is using, like we've already kind of said, the Gartley pattern is using precise Fib ratios, whereas the 1, 2, 3 pattern is not. A 1, 2, 3 pattern, and I know the 1, 2, 3 pattern very well as well, and I actually do like and use the 1, 2, 3 pattern to be fair. That's one of my other patterns. The 1, 2, 3 pattern doesn't have any real precise measurements. The only rule basically is that your number 3 point can't exceed your number 1 point. That's the only real rule in a 1, 2, 3 pattern, right? So it's fundamentally different in that you have a lot more structure and a lot more rules in the Gartley. So all numbers here is relative to the distance of XA. Not every single one, but most of them, yes. Most of the numbers are based off of the XA leg. Not all. A number of them are based off the AB leg. And I'll go through this stuff when I go through real charts and we look through them. And it'll probably make a little bit more sense. And I'll show you a couple at least real charts in this session as well before we wrap up. But for now, I want to keep going through the presentation. How often are the 3 different targets hit? Is there a reliable projection? Again, the projections the targets, the 70% win ratio, excuse me, that I quoted in the beginning of this pattern, was based on at least the first target being hit, the 38% retracement. Obviously, the deeper the target you're getting hit, the lower your probability. You know, if it's 70% probable that you're going to hit your 38% retracement, it's not 70% probable that you're going to hit your 1618. It's mathematically impossible. Even in a nonlinear dynamic system, you couldn't really do that. I mean, I guess you could, but you really, no. I mean, your probability would be reduced. So the key there is to have a trailing stop. I mean, that's how I trade these patterns. Again, you know, if I'm short from the D point or long from the D point, whatever the case is, once my trade becomes reasonably profitable and the next level of support or resistance has revealed itself, I'm going to start moving my stops with the market. I don't take my trades off at those target points. I let the trade go and let my trailing stops take me out, because a lot of times I'll think that it can only do a 38% retracement and I'd be happy to just take my 38% and run. Well, even though I think that, I also know that a lot of times, you know, I'm wrong. My brain is trying to do the best it can in terms of protecting me, but a lot of times it doesn't think that a move is going to go as far as it really could go, and that's not just me. That's all traders. I just acknowledge it. So using a trailing stop, more often than not, I'm able to capture much more of a move than if I had used a target. For instance, in my trading room, I run a daily online trading room for Forex, right? Some of you may even be in there with me on a daily basis. You remember the euro trade that we just, if any of you are, you remember the euro trade that we just took. When did we take it? Was it yesterday or the day before? I can't remember, but whatever. We just took a long euro trade, and we were long from 120. Now I gotta go look. Well, anyway, it doesn't matter. But we were long, okay, from basically a 125 and 125.42 was our initial entry, and we added it at 125.34 and tried to add more at 135 or 125.21, or excuse me, 13, but those didn't fill. So anyway, my point is this: had I run a target, my target would have only been maybe a move up to about 126.15 or 126.30 or something like that, right? Well, I didn't run a target. I ran a trailing stop, and I ended up capturing a move all the way to 127.03. Wasn't the high either, but I caught 160 points out of the move instead of 60. So, and that was simply because I used a trailing stop rather than using a hard target. Because the reality is, you don't know. Nobody knows where it's going to stop. So using a trailing stop allows us to, or allows me at least, to capture, in many cases, not every case of course, but in many cases, it allows me to capture more of a move than I would have had I ran a target. I'm not telling anybody to not use targets. I just don't. I'm just saying that that's the logic behind why I prefer to use a trailing stop, because I know from experience, for myself, I'm not saying for anybody else, but from my own experience, my own trading, I know that I'll more often than not capture a greater move by using the trailing stop than if I set targets. Okay, let's keep going on these questions, guys. Keep them coming. Is your entry at D or wait for confirmation? Well, your entry is at your D point, of course. I mean, I wouldn't trade this pattern completely alone by itself. You want to have some other confirming or denying pieces of the puzzle, and I'll show you the ones that I use here in a little bit. But you could, at least in theory, just blindly take the D point as your entry point and then run your stops at X. And yeah, your stops start at the X point. So here's the thing though, okay? Now this is very important. If you are, just because the rules, okay, this is really important. Just because the rules say that you get in at D and you run your stops at X doesn't mean you have to, and here's why. And this is the most important part for anybody, for any method. If you're not fundamentally comfortable taking that level of risk, like for instance, I didn't take this trade, okay? I would not take this trade. And I'll tell you why. And it worked. It made money. But that's not the point. The point is not whether or not you make money. The point is how you manage your risk. That's going to determine whether or not you're going to be here in the long run. So for me, personally speaking, the distance between the D point and the X point is like 350 points roughly. That's too much risk for me to take on. So I would say I don't care what this thing says. I don't care if a hand reaches out of the screen and slaps me in the face and says, short here, dummy. I'm not taking it because it's above and beyond my comfort level for risk. No matter how strong or how great the signal is, it's out of my comfort level for risk. Therefore, if I took the trade, I would be success of the pattern. I mean, not you, but the pattern is no longer going to show you that 70% success rate over the longer haul, because those statistics were built based on using the X point. Okay, that's all. 50% has a bit more to do with GAN theory. Yeah, that's certainly true enough. The way you enter, how did you decide to enter on the U.S. position, the Euro-U.S. position you mentioned? Example of a complete pattern, I mean, after it hit the target. Sure. Let's we'll get to all that in a minute. Let me go through these sub patterns real quick, and we'll go through this. Okay, the butterfly. So there's a number of sub patterns within the Gartley. They're not really, like I said, sub patterns. They're more like more specific patterns. They all share some similar commonalities to the basic Gartley construction. Certainly the AB equals CD portion of it is more or less the same across all these patterns. But here you can see that the measurements are different. Now we're talking about a much bigger, remember the Gartley pattern itself, the D point could not exceed the X point, okay? So a butterfly pattern is always going to come after a traditional Gartley pattern fails, okay? So once a Gartley pattern fails, it can then become a butterfly if it extends down to at least the 1618 projection of this. This D point then is a 1618 of the X point, okay? That makes sense? And for that matter, of the B point. So do you see how this is a little fun? And again, this was discovered by Bryce Gilmore. It's one of the patterns that offers a more precise potential reversal zone and more significant trading opportunities. The nice part about the butterfly is one of the favorite patterns of all of those of us who use these Fib-based pattern recognition stuff. The reason it's one of the favorites is because it does offer you a fairly precise entry point, and you can run a fairly tight stop below the D point, obviously, and a lot of times you're going to catch a sharp reversal. All these patterns are reversal patterns, okay? These are patterns that are attempting to help you pick tops or bottoms, which theoretically you're not supposed to do, okay? So keep that in mind. This is not usable or useful in any way, shape, or form for trend trading. Well, I guess that's not true. You could catch the beginning of a new trend with this stuff, but it's not that, whatever. It's turning point trading here that this stuff is for. Range trading. I'm a range trader. You guys that are regulars with me here on FX Street know that. I can't stand trends. I don't trend trade. The only reason I identify trends is to know what markets I don't want to trade. Okay, so here's the how-to on the butterfly. This pattern must have an AB equals CD pattern within the AD swing, much like almost all of them. An extension move beyond the 2.618 of the XA leg is generally the maximum risk. And again, you can modify that. I've certainly modified my stop below the D point for a number of different ways. If you want to be classical about it, you would want to go below the 2.618. The X point for a buy pattern or above for a sell pattern. The B point below the X point. B above or below the A point. Failure of the D to extend beyond X. D must extend beyond X to be a butterfly pattern. So that's the point here. That's really what separates the butterfly from the others, is that D has to be below X, unlike the other one, the traditional Gartley, where it has to be above it. This is one of the most precise of all the harmonic patterns. This one was discovered by Scott Carney in 2000, so it's a relatively new discovery. And it is similar in its construction to the butterfly. It just basically has an even deeper correction on the, an even deeper move from D to X, even a bigger kind of a blow-off move, if you will. So that's, I don't want to get too deep into this one, but the bottom line is this is, really that's the bottom line, is it's a much deeper move from C to D that differentiates the crab from the butterfly. Critical aspect of this pattern is the tight potential reversal zone created by the 618 of the XA leg and an extreme. The pattern requires a very small stop loss and usually provides an almost exact reversal in the potential reversal zone. I don't like using that word exact, but I'm glad the word almost is at least there, but it does get very close. Now this pattern is very hard to come by. You're not going to find the crab pattern very often, but when you do, it can offer a lot of great opportunities. The bat is also an incredibly accurate pattern, requires a smaller stop loss than most other patterns as well. The bat pattern is similar. You can see here this one looks a lot more like the traditional Gartley because the D point is still above the X point, but it goes a little bit deeper. You remember the Gartley down here only really goes to the 618 retracement. This actually goes to the 0.886 retracement. There's a few other little differentiating factors here as well. For instance, this XA correction only goes to 50% instead of 618. That's one of the other differentiating factors. If you just look through these, you'll see and get a grip on the Fib ratios here. You'll see the differences very easily of what each of these patterns are. I realize when you're first looking at this stuff, it looks very complicated, and you've got all these numbers and all these precise ratios and all that, and it seems like it's a lot to take in. And I'm sure it probably is at first, but honestly, it's very, very easy once you get good at it or comfortable with it. And it doesn't take that long. I mean, if you're comfortable, most of you are probably already fairly comfortable with Fibonacci stuff. You just haven't looked at it maybe as precise as we do with these patterns. So how to use the bat? The bat pattern incorporates the 0.886 XA retracement as the defining element of the potential reversal zone. The B point retracement leg must be less than 0.618, preferably a 0.5 or even a 0.382 of the XA leg, and the bat utilizes a minimum 1618 BC projection. In addition, the AB equals CD pattern within the bat is extended and usually requires a 1.27 AB equals CD calculation. Do you guys know why 1.27 is an important Fib ratio? And you notice, like, I think MetaTrader, when you use the default Fibonacci retracement ratio tool that they have built on MetaTrader, it doesn't have the 0.786 Fib retracement as a default parameter. You have to go in and turn it on yourself, or type it in yourself in the settings. But do you guys know why 0.786 and 0.127 is so important, and why a lot of traders overlook them? Anybody into math here? Anybody a math person? What is 0.786? What does 0.786 represent from the Fib ratio? Bingo! It's the square root. Joseph, you know this stuff. That's great. 0.786 is the square root of 0.618. 1.27 is the square root of 1.618. Square roots are important in mathematics for a number of reasons. And then you can talk about squaring a circle and geometry and all that kind of stuff if you really want to go there. But anyway, that's why 0.786 and 1.27 are important Fib ratios as well, often overlooked by many traders. All right, and lastly, the 5-0 pattern. The 5-0 pattern is pretty much the newest one that they've come up with. It's a unique structure that possesses a precise alignment of Fibonacci ratios to validate the pattern, primarily defined by the structure's B point, as is mandatory for all harmonic patterns. Like I said, the B point in all of these things is critical. It's the heart. It sets the. The 5-0 requires a reciprocal AB equals CD measurement to define the pattern's completion as well, just like most of, pretty much all of them. The basic premise of the pattern is to identify distinct reactions following the completion of a contrary trend. Valid 5-0 patterns typically represent the first pullback within a significant trend reversal. So here's the 5-0 pattern. On patterns like the bat, should we still expect AB equals CD in time? Yes, but not per se in equals. In terms of fib ratios, you'd want the time aspect to be there. So you don't have to have, just because AB leg is 8 bars doesn't mean that CD leg needs to be 8 bars. It can be something within the fib sequence ratios. Like I was saying, you could have like 11 bars and 17 bars would be great, because then you have a 1/6 ratio between 11 and 17. If you divide 11 into 17, it comes out to 1/618, right? 1.618, I mean, sorry. Okay, let me see. There's so many questions. Tick charts. Do you see these patterns in tick charts where time is not fixed? I don't use tick charts. I won't even look at them. I'm sure they probably are there, but I will not use tick charts. Yeah, we'll have this PowerPoint available for download and all kinds of stuff. What is your favorite time frames for these patterns? 15 minutes and 60 minutes are my favorite. For all patterns, not just these. Yeah, sure. X is right here. A, B, C, D. All right. So now you should hopefully at least understand how to recognize some of these patterns. I realize that you're not going to be able to do this instantaneously after an hour and a half presentation, but the point here is to introduce these concepts to you and get you thinking about them. And if you're interested in taking your own research a little further, then by all means. And I have lots of material here that you can get to further your studying of these patterns. A lot of the source material that I've used even to put this together, I'm happy to share. Anyway, with practice, you will know how to recognize these patterns quickly by drawing a couple of fib lines. So if left. All right, so we're going to do a little quiz. Yeah, I'll be finishing up mod for sure. With it, probably actually in the next 10. I've only got a few slides left here, and then we'll live charts in the last minute or two just to see it happening in real time, and start our break, and then we'll start back up at 11 for the premium members. Okay, quiz time. There is a prize at the end. Question number 1, what is this? Anyone? Right. Bearish Gartley. What's this? Right, it's a bat. Bullish bat. Some people were saying butterfly, but it's actually a bullish bat pattern. Again, that's defined by more or less the B point and the D point are kind of the most important parts of that. What's this? And the last one, what are we looking at here? This was actually the Gartley again. Straight up bearish Gartley. All right. Oh, wait. So give me a second here, and I'm going to pull up. So questions. Hit me with some questions now, guys. I mean, you've all had great questions so far, so don't get me wrong there, but keep going with any questions about the overall presentation, the overall usage of these patterns, lack thereof, whatever. And any other questions that you may have already asked that I skipped over. If I skipped your question, don't take it personally. It's not that I don't want to answer it. I just missed it. Other indicators that you use to confirm your entry. Yeah, I'll go over that in a second. Book titles about this subject. Scott Carney wrote some books called The Harmonic Trader. Well, he's more than that. That was one of his books. He's written a number of books. Bryce Gilmore wrote some good books that talk about these patterns. Larry Pesavento wrote a fantastic book called Fibonacci Ratios with Pattern Recognition that is available from Traders Press. I think it's a relatively cheap book too. Brilliant, brilliant book. Larry should be charging thousands of dollars for that book, but I think you can get it for 20 bucks or something. So there's a number of good, but there's lots of other people who use these patterns, and there's lots of other people who use whatever. But you want to the guys that I've used as my source materials, primarily Larry Pesavento, Scott Carney, and Bryce Gilmore, just like you saw their I've said their names now a couple times. I'm not endorsing these guys. I don't know them really. Any of them. I've not worked with any of them really. I have talked to a couple of them on the phones over the year, on the phone once in a while, but I don't have any. I'm not trying to endorse or anything like that. But you asked who I read, so that's why I say it. Do you ever buy and sell C with a target to D? No, I don't. Some people do, but I don't. What are the sub patterns? Are the crab and they're not sub patterns is a bad way of naming it. I shouldn't have called them that. They're more precise, more specific Gartley patterns is really a better way to look at them. But they're what we went over already: the butterfly, the crab, the 5-0. Slightly confused at entry levels for other than Gartley. The entry levels are always the same. They're D. No matter what the signal, no matter what the formation, whether it's whether it's bearish or bullish doesn't matter, and whether it's whatever, a crab, a Gartley traditional, whatever, the entry point's always the D point. And it's not at a precise point. The D point is always a range too. The D point is always going to fall within a certain amount of range. Like I said, like you saw on the presentation there, a number of those D points had, were a 1.618 to a 2.618. So whatever that range is there, D point is always the entry point. Actually, you draw the fibs first, and then the fibs are going to uncover the patterns more than anything. Here, let me pull up a chart here. All right, so we're going to start with a totally blank chart. Okay? I'm going to do this the old-fashioned way first. So we're going to pick some points here. This looks like a significant high. What is this now? This is an hourly. Okay, this is the Euro US on an hourly. So what do we have here? We have a 38% correction. And if this is the X to A leg, so far we have a 38% correction. What does that tell us? It tells us that we may be building a 5-0 pattern, or even a traditional Gartley. It's not complete yet, of course. So it just alerts us to the fact that, hey, there's a 38%, something between a 38 and 61% retracement here, depending on where that ultimately rolls over and turns back down. If it does, I'm not saying it's going to, but if it does, if it turns back over and starts going back down, then we'll know, and it's between these 2 points basically, then we'll know that we're close to a B point. And then we'd look for the C point and then go from there. Does that make sense? But you really, if you don't need to get any more fancy than just using the basic fib levels that you're all familiar with. It's just understanding that there's a lot more to it than just the overly simplified, oh, well, we had a 38% correction. Okay, well, there's a lot more. That's That's like, I don't know. How do I explain this? That's like seeing a Ferrari, okay? And uh and saying, "Wow, that's a red car." Yeah, it's so much more than just a red car, isn't it? See, most traders don't realize that you have a Ferrari in terms of your tools at your fingertips. Most of us, myself included, for a long time at least, drove our Ferrari as if it was a Fiat, right? So all you got to do is realize that, hey, wait a minute, I actually have a Ferrari under my butt here. Why don't I drive it like a Ferrari instead of driving it like a Fiat? If you haven't looked at all the other parts of this puzzle here, and that's kind of what I'm trying to get at for you guys, is that there's a lot more to these fib ratios than just simple retracements that everybody's so familiar with. That's really a gross oversimplification and almost borderline misuse of what fibs are really telling you. All right, so I do have a cheating method now. Of course, with MetaTrader, they've built EAs for everything. So, and you guys are asking what other indicators and stuff I use. You can see here, this pre-draws all these measurements for you. It really makes life a little easier. And then you can just cycle through the time frames and see if there's any patterns that are in play right now. And I think you can pretty clearly see here on the euro that at least in the time frames that I look at, which are the 15, the 30, the hourly, and the 4-hour, there's nothing. So there's no reason for me to take a Gartley-based trade. It doesn't mean I won't trade it. It's just it wouldn't be a Gartley-based trade, right? The other indicator that I use is the Hurst exponent, which is what this is. There's no way I can explain all that in the 2 minutes that I have left, but you asked what I use, so there it is. This MACD I don't really use. I just kind of have it on my screen for research purposes. Oh yeah, Dave, thanks for saying that. Okay, for you guys that want to get this EA or whatever and add it to your thing, you can get it as well as some other articles and some audio interviews and everything about these patterns for those that want to do more homework. Get it all off of our main web page there, I believe. It should be working. Thank you very much. Based on this chart, when to enter assuming that it's a Gartley pattern? You're talking about this one? Well, it isn't a Gartley pattern right now, so if it was, your entry point would be as close to the D point as you could get, which theoretically would be here. But it's not, obviously, a pattern. If it's a Gartley pattern, it's going to show up. It's going to look like this with this EA. So this is the Australian dollar. This is a 15-minute chart. Now I'm going to flip to a 30-minute chart. Now in an hourly chart, you can pretty clearly see here that we have a bearish bat pattern in the Australian dollar. Pretty well pronounced. You see this? I don't know if I'm broadcasting this now or not. Do you guys see this? So there's your bearish bat pattern. So your entry point is up here inside of this little square. Entry range, of course, it's not one point, your entry ranges. And then your targets are basically down in here. First target, this is a different targeting system. I don't use this targeting system, but this is part of the EA that's built in, so whatever. But yeah, the blue triangles are drawn auto. So the RFC's got a bearish pattern right now. Let's flip through these real quick. There's nothing on the euro yen. Dollar yen, you've got a bearish butterfly pattern right now. You can see, in the short-term basis at least. I'm ignoring that, to be fair. It's showing up in the hourly time frame as well, and the 4-hour. So I actually might stop ignoring that and start paying attention to it because it's across all the major time scales that I care about. Oh, and the daily too. So yeah, you definitely have a sell signal coming out of the yen right now. Somebody was asking about showing one of these patterns that had completed. This hasn't quite completed yet. Oh wait, yes it has. This is a bearish butterfly, and to get the projection, again, you measure the XB leg, and you get a 1618 projection down here. You'll notice that the short signal was generated at about 144 and change, roughly, and it just covered at the 1618 level, which is where it is basically right now, below 143. Make sense? Yeah, your target, the first target's 38%. Second target would be 62%. It's traditionally. I mean, I'm not telling you that's what's going to happen. I'm telling you that's traditionally how the targets are done. All right. So I do have to wrap it up here. We're going to take a half-hour break. If there's any other questions, ask them now. Half, of course, is for the premium members. And we're going to do more of what we just did here in these last 5 minutes, which is actually going through and finding these patterns, looking for them. If I find something that's reasonable, I will take the trade. I'm not telling anybody to take the trade with me. In fact, I'm just doing it for educational purposes. So if you follow me into the woods, you're on your own. You still got to manage your risk to your satisfaction. But anyway, that's what we're going to do here on the second half. Any other questions? Was this helpful for you guys? I hope it was. You know, there's not a lot of patterns out there that offer you this level of accuracy going back historically, and not a lot of patterns that tell you not only where to get in, but where to expect it to go, and where, most importantly, of course, when to get out at a loss, where to place your stops. That's the most important part of biology, and it's all spelled out using these patterns for you. So there's, like I said, there's really no more guesswork. Modify the rules as I have done for myself and for my own comfort level, but you know, and I'm not changing night to day by modifying the rules. If I'm modifying anything, I'm just modifying stops more than anything else. And again, that's just because I need to fit it in within my own risk matrix. Your risk matrix, whatever you use for risk matrix, has to override everything else. Has to. Like I said, I don't care if a hand reaches out, slaps me in the face and says, "Sell here, dummy, it's a guaranteed lock." If the risk that I was forced to take is unacceptable in the first place, the business taking that trade. So your risk management matrix has to override everything else. So, all right, guys. Thank you